Trade tariffs were the weight of the day. This has been a crazy week when you actually look at what's going on here. We started out on Monday was a holiday, so markets were flat. That was an easy day. Tuesday, the markets are down 30 points because of concerns about Italian banks. Then the markets are up yesterday because apparently Italian banks don't matter anymore because central banks are just going to bail everybody out. And then today markets are down again because of worries about over trade concerns because, well, Donald Trump is now imposing tariffs not only on the EU but also on Mexico and Canada. And now Canada is retaliating with tariffs. And this is what is called a trade war. And this is not good economically speaking. And then, of course, Donald Trump tweets out that he's talking about putting a ban on all like Mercedes, BMW, etc., because that is the bigger issue. So again, the point here is simply this, is that at the end of the day, the one thing that we want to pay attention to is what's actually happening within the overall economy. Now, let's talk about the markets for just a moment. The 100-day moving average has been the level of key support that we've been watching now over the last several weeks. After we broke above this 100-day moving average, we did add a little bit of exposure to portfolios, but we're still holding a severe overweight position in cash. Now, outside of that, this consolidation process has continued above this 100-day moving average. Now, last week we broke through, or actually on Tuesday, we broke through that support. Now, immediately we got lots of emails from people going, hey, should we be selling right now? We broke that support you've been talking about. And I said, no, what we need to do is simply sit on our hands at the moment and wait for the end of the week. And sure enough, the next day the market's back above in this trading range, and we maintain that level today. So absolutely nothing has changed this week, despite the fact that we've had a real increase in volatility. So this is what we want to keep paying attention to for right now. Look, I want to back this up, though, just a little bit. This is a daily chart. I want to take this out just for a second, and let's look at this from a weekly perspective because you get a much better picture about what's happening with the overall markets in a longer-term period. So when we look at this going back further, and look at the markets in a 2-year period, what you can see here very clearly is this very defined consolidation process within the market. This compression of the market prices, this action on a weekly, and this is why we look at weekly data versus daily data, and particularly when it comes down to managing money, because you get a much clearer picture about where markets are headed, and so you can reduce the emotional stress about what to do with your portfolio. Take a look at this compression. This is like coiling a spring, and the spring is getting tighter and tighter and tighter, and this is what is known as a binary outcome. This is only going to happen in one of two manners. Either the market's going to break above this consolidation and move higher, or we're going to break down and move lower. There's a real risk here that we could break down and move lower, and let me tell you why that is. Back in 2007, as we were heading into the 2008 timeframe, Bear Stearns started getting in trouble because of their credit derivatives, particularly in the mortgage markets and in the mortgage-related investments. Interest rates were rising, but it was a Goldilocks economy. Subprime was contained. It was absolutely no big deal. The problem here is that Bear Stearns, nobody really paid much attention to it after it failed. In fact, markets actually rallied back to basically highs of the year right after the whole Bear Stearns bailout by the Federal Reserve and by JP Morgan. But that didn't solve the problem because later on that year, September the 18th, was when Lehman Brothers failed and it froze the credit market. One of the big areas that we're looking at right now that is a real problem, and I want to pay attention to this, particularly over the next couple of weeks, is looking at Deutsche Bank. Deutsche Bank is one of the largest European banks in the world, and over the course of the last really couple of years, this has been in a steady downtrend over this period of time. Deutsche Bank has the largest level of derivatives in the world, period. Deutsche Bank's trading at $11 a share. This is the same thing we saw with Bear Stearns. Bear Stearns went from $159 to $2 a share in 365 days. Deutsche Bank is a crisis of Lehman proportions about 4 times as large. So if there is an event because of rising interest rates impacting dollar swaps, derivative swaps, interest rate swaps, etc., and something blows up on their balance sheet, the derivative spread of that through the economy could equal what we saw or greater than what we saw during the financial crisis. This is something you want to pay very, very close attention to, and that's why I'm saying the risk to the market is potentially to the downside until we start to resolve some of these issues, both financially and economically. So pay attention to this, keep a watch on money. This is why we continue to hold a little extra cash in our portfolios as a hedge until we get back to this process of breaking out of this consolidation pattern and getting this consolidation back into an event where we're seeing the markets actually move higher. And again, we need to break out of this consolidation to the upside. If we break down here, and particularly since this is a weekly chart, the downside break of this could very easily take this market back to 2,200 without much of a stretch of imagination. Of course, that type of correction is going to wipe out basically 2 years of gains. So again, kind of watch what's going on with your portfolio. If you need help, feel free to go by our website, realinvestmentadvice.com. Send me an email. I'm always happy to help you. Richard, Danny, we can review your portfolio, see what you're doing, see what you're not doing, make some recommendations. We're always happy to help. realinvestmentadvice.com. If you need to schedule an appointment, come in. Happy to see you too.